we are now getting to a point of not just motivated selling, we are moving into distressed selling. And so I don't think that the rates staying high are going to keep the inventory from coming.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up. We're fortunate to have with us Melody Wright. Melody is the owner and founder of Haringa, a mortgage strategy and technology company. She's worked in the mortgage, real estate, and technology spaces for more than 25 years. Melody provides much of her research on her M3 Melody Substack. Melody, welcome back to Metals and Miners. Thank you so much for joining us today.
Thank you so much for having me. It's my pleasure.
So let's begin with the California fires, a very sad situation, and our prayers go out to those communities. The potential exposure for California insurers right now is at $458 billion is what I'm hearing. Current damages are now estimated between $150 and $250 billion and rising. A few short months ago, many homeowners' insurance policies in the fire areas, they were canceled. Insurance companies exited and homeowners became highly reliant on the California Fair Plan. It's an insurance program that reportedly has less than $700 million on hand to pay claims. This is what's really happening in the state. They really have no money. I think their budget deficit is estimated to be over $60 billion on top of that. The amount of net losses far exceeds the net assets of insurance companies and banks. Can this horrific situation lead to financial contagion and possibly crash the economy?
That's a question for me. Yes. So, it's so early. There's a lot going on. For instance, the insurers, the private carriers are going to have to backstop that fair plan if it does not have enough capital. But a recent decision just made it possible for them to transfer some of that increase to the homeowners as well, future homeowners, I should add. So, things are getting very precarious in California, and I want to be clear that they were already not looking that great. You had unemployment at 6%. Around 6%. It was a little bit less, but 5.8% in Los Angeles. You had a over 16% poverty rate. You also had people leaving in both the city and county when the U.S. in general has, recent census estimates tell us that we've increased 2.6% since 2020, when the last, census was done. So you just didn't. And the entertainment industry is faltering. And now what's really important about Los Angeles is their GDP, or gross domestic product, is bigger than the state of Pennsylvania. They are a huge contributor. And now you had the entertainment industry, which was a big part of that, also suffering, right? Since the writers' strikes, it just feels like they can't get back on their legs. AI is threatening them as well. And ultimately, I think box office sales are down 23% since 2019, and even down from last year. So I want to give that macroeconomic picture first, because I think people believe that everyone in California is rich, and that is just simply not the case. There are little enclaves of that wealth, but in reality, California is not structurally strong, even though they are a big producer of GDP. So I think this crisis, Gary, could be significant. I think that along the chain, will it be one insurer that becomes insolvent? Maybe not. Maybe it'll be a reinsurer. Maybe it'll be someone else that took out certain bonds, those bonds, the catastrophe bonds. What I can tell you is everybody has a lot of opinions, but they don't have a lot of facts. And what you can do is look at Fort Myers after Ian. Everyone there said that ultimately, the investors would grab up that beachfront property because and pretty much kick the residents off, right? The longtime residents. But in reality, what happened is because of the insurance costs, it did not make, and because of debt service costs, higher for longer, it made 0 cents to buy and hold that land. And now you have inventory exploding in Fort Myers, beachfront properties, that are kind of demolished with that for sale sign. So your original question was, could this cause some sort of systemic issue? Absolutely. It might not be in the most obvious ways that you think, but California is the top mortgage, by origination volume in the country. And so you've now got issues, disasters in California, Florida, and Texas, which are the top 3 markets. But I'll pause there. And
there's a lot
I said a lot.
Well, there's a lot of threads to pull on there, but
Yeah.
Melody, I'm curious, how is it that the California banks suddenly allowed so many large mortgage holders to go without homeowners insurance in that area?
Well, they wouldn't. I mean, if they had now, this is where, Gary, a lot of the unknown unknowns come into play, because I think California has a very large private note market. And this is not anything anyone's talking about right now. Now, what are private notes? That's where let's say you have extra capital. Everybody and their mother has told you how awesome it is to get these 30-year amortizing notes. You just decide to go lend out yourself, use an attorney. A lot of these jumbo lenders and very rich people use this. They'll turn around and say, hey, you want to buy my house? I'll do some seller financing. This was really big in the 80s when rates were higher, and this has gotten a new kind of uptrend. And so if they have those types of mortgages, those people might not have been sophisticated enough to require insurance. So we don't know. We do know a lot of them were uninsured. But if you have a mortgage that's backed by Fannie Mae, Freddie Mac, or FHA or VA, and even the jumbos from the private banks, they are going to require you to have mortgage insurance and homeowners insurance. Sorry. And ultimately, if you don't have that homeowners insurance, they'll force place it on you. And that's been a huge area of litigation in the past. But so it's a little bit more complicated.
So it sounds like there's going to be a lot of untangling here over the next, who knows, 6, 12 months or longer. So you mentioned the LA unemployment prior to the fires, unemployment in LA around 5.8%. Current mortgage delinquency for zip codes impacted by LA fires is a little over 1%, with a national average a little over 4%. Prior to the hurricanes that hit North Carolina and your area of the country, Asheville's unemployment rate was 2.6%. And now here we are several months later, it's more than double at 6.1%. Mortgage delinquency in Asheville was 2.3% prior to the hurricane. And it's more than tripled. It's over 7.5% now. So are we likely to see similar large upticks in unemployment and mortgage delinquencies in LA over the next few months? And if so, what are the ramifications and ripple effects there?
I think so. And you just think about all these homes in Pacific Palisades. Think about the gardeners, the housekeepers, the businesses that supported those, the nail salons, the restaurants, all the little shops that would have been there to support that large neighborhood. All of these people will be without jobs. And then you look at the gig economy has been suffering enormously. And I think that a lot of times people will go into the gig economy versus filing for unemployment because they can make more money, but that is becoming saturated. And so, honestly, I truly believe that we are going to see, upticks in unemployment and upticks in mortgage delinquency. And what a lot of people, so I personally manage default. There's not many people out there that have done that. And I can tell you that the people most likely to strategically default are the wealthy, because they can walk away. A lot of times they've put that mortgage in the name of an LLC or a trust with no personal recourse. They have accountants and lawyers that know how to hide that stuff. But during my time on the GFC, Gary, the people that were calling my CEO the most, trying to figure out how not to pay their mortgage, were all those wealthy on the Jersey Shore area.
So we can expect more of the same here.
Yeah. And California is notorious for strategic defaults. They do things like file bankruptcy the day of the foreclosure. I mean, they're very crafty out there.
Well, the banks already have challenges with the commercial real estate loan portfolios that they're holding. So now they're going to be holding this. What does this mean for the banks?
Well, they're going to tell you they're fine. But that's not true either. And really it's all about the chain. So we need to look at all this as a system, and it may not, like I said, it may not be a big insurer that implodes. It might be somebody that's been providing liquidity on the reinsurance. And so, I think that's, we could absolutely see the banks who lend to the non-banks. So the non-banks have no deposits. Okay. They are the largest servicers of this. So everybody always says the banks, but they forget that since the GFC, due to Basel III requirements, the banks pulled back from mortgage lending. Your biggest entities are your non-banks now, and they don't have deposits and they don't have liquidity. The banks give them liquidity. So you could see that kind of domino effect when they have to turn around. They breach a covenant. They can't pay back their obligations. Then the banks come into trouble. So you may not see the big banks really suffering for a couple more quarters.
You expect the Fed to come in and do something there to help them, and then downstream from there?
Um, so even before this new administration got voted in, the Fed has very limited power in terms of what they do in controlling rates. Now, what they could do is they could buy mortgage-backed securities again, but if they know that's inflationary, and so if they do that, they know they run the risk of not only inflation but absolutely infuriating their base. Because believe it or not, people now can articulate why home prices went up, and your regular Joe on the street, you might find them saying because the Fed bought MBS, because it is so obvious now what happened in the housing market. So I think politically hands are going to be tied.
Interesting. All right. So according to the Realtor.com December housing market report, prices in more than half of the 50 largest metros in the US have plummeted year over year, with 5 hugely popular cities leading the charge in price reductions. Is this spreading, and are we likely to see reductions go deeper in the months as 2025 carries on?
Yeah, Gary, that article is hilarious to me because, I get called a doomer for saying we're going to have a little price correction, right? And at realtor.com, it's using the word plummet.
Right.
And so, yeah, that's spreading. And by the way, that's not even the half of it. And the reason I say that is because we know credit scores were inflated. We know appraisals were inflated. Fannie Mae put out an appraisal letter saying they looked at 7 million comparables, and 55% of them had didn't list seller concessions, meaning those values were inflated. And so you have to, and then you can look at your Zestimate, and your Zestimate can only tell you what you need to know if you've had sales in your community. Well, as you know, the housing market has been frozen. And from a combined home sales perspective, this is one of the worst housing markets we've seen, even worse than the depths of the great financial crisis. And so when you aren't moving product, and then you got the builders who have almost, I think it was 9 months of supply. Put it this way, it's the most supply since they had their mea culpa in 2009. And they've said very loudly, Lennar, pace versus price. And so they are coming in with aggressive rate cuts. And so, yes, this hasn't even started yet. Realtors telling you that because they want you to come to the market. That's it.
I have some inventory questions for you, but Melody, mortgage applications continue to drop. You just kind of touched on it. We're now 63% down since the pandemic high. As far as I know, there might be a different number, but mortgage loan officers, they continue to get laid off. In fact, approximately 75% from what I'm hearing of loan officers from 2021 haven't even renewed their license for 2025. So, and total housing sales, as you touched, I think it's down to something in the 90s, maybe the 80s.
Existing home sales since 1995. And we've increased population by 12% since the late 90s.
So it just doesn't seem like the housing market's adjusting very well to the 7% mortgage rates as the new normal.
I honestly, I think it's the prices. I think they'll stomach the rates. Because in reality, we know since the 70s, the average 10-year treasury rate or average mortgage rates were 7%. And so, I think the prices, that is really the biggest issue, plus these additional costs of insurance and tax. But a lot of that is based on that appraised value, you know?
Yeah. So we're talking about interest rates here. It looks like the 10-year yield is approaching 4.8%. It's pushing interest rates higher and higher, and they're on their way to 8%. And it's kind of odd. So since the Fed pivot over 120 days ago, interest rates are up more than 110 basis points. That's never happened before. What's the impact here from these rising interest rates? Is there no impact? Or combined with the high costs, I mean, are we seeing?
Well, so it's so important to understand all these levers, right? Because they're going to get pulled at different paces and things like that. So there is an impact. But when you are distressed, so what happened last year is, Powell came out in last December of 2023. Everybody thought he pivoted. Everybody thought there were going to be 6 rate cuts. That didn't happen, but it brought inventory to the market. Well, then what happens over the summer? Same thing. Oh, finally now inflation is cooling. We're going to get our rate cuts. And so you started to see the 10-year move down and with it mortgage rates. But then kind of things changed and people have a lot of ideas about why that happened. And I think all of them are true. And that's the problem with what we do, Gary. Everybody wants one reason. In reality, there's so many reasons. So my long answer to this is yes, it's going to have an impact where that rate narrative of lower rates brought out inventory last year because everybody's like, oh, yay, it's finally happening. We are now getting to a point of not just motivated selling, we are moving into distressed selling. And so I don't think that the rates staying high are going to keep the inventory from coming is my answer to that. Now, with transactions, the only way those are going to move forward, either it's going to be your top, and really we're inching so far up the K now, it's your top 10%, and they're kind of tapped out too with all of this because the taxes and insurance don't make sense unless they're transacting. The only way the biggest part of the market transacts is if prices go down with those higher rates.
So, a lot of people have been anticipating a crash in the space, but it hasn't happened in the way like, 2008. But this is kind of like moving a super tanker versus
the Titanic.
Yeah, versus, a little speedboat that's going to just like flip
Oh,
over
yeah.
fast and hit a wave.
And you can look back, everybody thinks that the GFC happened in 2008. For mortgage, that thing lasted all the way to 2015 for the most part. And really, some would argue, and when you look at the GFC and the COVID boom, we never reached those levels. So, I think that's people have a misunderstanding about kind of even what this last boom meant, and it never reached those highs. So.
Well, let's go back to inventory. So how does today's real estate inventory compare to the long-term average? And then also, how does it compare to even just before the pandemic in 2019?
So here's where it's just, I think a lot of things have happened. So you cannot get inventory data from National Association of Realtor prior to 2017. They will not give it to you. You have to pay for it. I'm hoping somebody will give it to me as a present in 2025 because last year I got existing home sales data and it changed everything. But I think there's a couple of reasons people think inventory is low. And I think that's because we started using social media and we also started using technology to move and sell homes. And so I think that NAR, who is the biggest spender in Washington, thinks inventory is low because there's actually an inventory shortage. I think what's actually happened is alternative ways of buying and selling homes have cropped up. And that's where a lot of the inventory is hiding, as well as the inventory is hiding in those those speculative Airbnbs. You can go to any of our cities. You can come to Johnson City, Tennessee, which is tiny, and find it everywhere here. It's everywhere.
are you saying that the data for inventory is on par with data for jobs?
Right. Well, look who,
It's not.
yeah,
It's
if
not
you
that.
pull, exactly, you pull up Fred listings for sale right now and you go to the bottom and you look at the source, Gary. It's realtor.com. Realtor.com gives the Fed its inventory. Like that's how we know what inventory is. They
Yeah.
don't have vested interests, do they? I mean, you just and so and let's look at NAR. In 2011, they were forced to restate years of prices because CoreLogic looked at the recordings at the county. And so let's put it this way: they don't have any vested interest and telling us what's actually going on. And it's so convenient that the builders will list one home on the MLS, which is how Realtor gets this information, when they might have 400 homes sitting there. And so, what I had to do back in 2023 was go on the road and look for myself because you couldn't really see the permit data none of it made sense. And so I can tell you that what's listed with the Fed, um, for inventory does not include the new builds. It does not. And so you've got to look at both of those together. And we are doing just fine from an inventory perspective. Like I said, we've got more new homes than essentially we've had since 2009.
What about already built but not sold inventory, and then
Yeah.
also permitted but not built inventory? What is that telling you?
Yeah, it's all high. I mean, but it also is telling me what I saw on the road. There were a lot of projects that were even stalling in 23. Unfortunately, we were in an election year last year, and reality was just not something anyone could afford to put out there.
So did builders overbuild during this cycle? Is that what you're saying?
Oh my God. Oh yeah. I mean, you can go to play. So on an aggregate level and also locally, because people are always like, real estate's local. Yeah, locally they really messed up, but they also did it on an aggregate. I mean, every space in the Northeast, all around, everybody's like, no, not really in the Northeast. Yes, in the infill spaces, they put homes every single available space. I saw it in Pittsburgh. You see it in the Northeast. It looks a little different, but there is plenty of inventory. It just may be misallocated right now to either those who own short-term rentals, long-term rentals, etc.
There's been a debate about, if there's an ownership shortage or if there's an ownership imbalance going on here. Do you see this as an ownership shortage or an ownership imbalance where, maybe there's just so many who own 2, 3, 4, 5, 6 homes, and when they go to sell, there just won't be enough buyers at these historically high prices? How do you see this?
I think that's more it. I mean, I've even talked to millennials who have been sitting on second homes, third homes that they bought because they wanted the passive income, but they ran out of money and can't do the repairs. And they've been waiting for lower rates. So I think at this point, we've got 15 million vacant homes in our country, not abandoned, vacant. Those are being used for different like vacation use, short-term rental, things like, and I cannot wait actually till we get updated numbers, as if I believe we'll actually get all the numbers. But still, I think it's going to show that's more. And so then you have the boomers who, are it's time, they're getting ready to get rid of those homes as well. A lot of those they'll give to their kids if their kids want it. But what I'm finding right now, to be real honest with you, is they want the cash. I've been contacted over the holidays by multiple people who are in a inheritance situation and they just want to sell the property.
So what happens if all of those, not all, but if a huge amount of those properties flood the market?
Well, what happens indeed. So that's, and I honestly think in the spring we'll get a little taste of that. Now we've got a lot of Trump optimism right now. We've got a lot of people who feel really good about the election. We've got businesses who think that, the regulatory environment is going to improve. You've even got builders who think that as well. So we've got to give this optimism its due, which means even though mechanically it seems as if we should see real distress coming by early spring, it could take more into, kind of the end of the first half of the year or even into the second half of the year.
To your point about the optimism, I just read this morning, one of the major banks was saying that they're expecting an increase in 2025 in IPOs and mergers and acquisitions, which they have not seen, since pre-COVID or just right after with the SPACs and everything like that. So it's going to be interesting to see if that optimism, falls flat or if there's follow through there. Melody, there's very large upfront fixed cost of buying a home, especially at these record prices. You have the upfront deposit, which is higher than ever in an inflationary environment for almost 5 years, where it's been difficult for many to save. And then you have the all-time high monthly mortgage cost, but then you have variable costs on the backside of the purchase that really have no cap to them, from insurance to property taxes to HOA fees, repair, maintenance costs more. All of these have skyrocketed higher over the last few years, catching many who purchased really since the pandemic by total surprise. That was not built into their budget at those levels. And there's no end in sight to the inflation of these variable costs. There is no cap to them. So due to these high variable costs that many didn't take into account when signing on the dotted line of their mortgage, are we already seeing increased selling pressure with an increased probability of a spike in inventory moving forward here?
Absolutely. That's what's happening in Florida and Texas and even certain parts of California. And you can see that the 2021 vintage, and what vintage means is the year it was originated, is as a percent of delinquency is the highest. Now that's when most loans were made, but you really shouldn't see that recent, and it's accelerating quickly. And what's important there is the rate of change. And so there's a lot of distress coming from those recent originations, because to your point, even in California, where everybody's like, oh, but you have Prop 13, you're not going to get those increases in property taxes. Well, what happened is when they sat down with their originator, they looked at what taxes were the year before, and it was like, yeah, $6,000, blah, blah, blah. Okay, that's fine. We'll put that in escrow, no big deal. But then 6 months later, even though their originator told them this, people are never listening when they're signing those papers. They get a big supplemental tax bill, and that it could be $15,000, $30,000 that they have to pay all of a sudden. And what will happen? They'll call their servicer, and many of the servicers will advance it for them, but then they have to tack that onto their payment. Think about a $15,000 assessment. What I saw escrow notices last year go out that were double and triple, and even this is true, quadruple. That wasn't the majority, but you saw that happening.
And that wasn't budgeted.
Absolutely not. Can you imagine getting a letter in the mail saying, sorry, your mortgage is now $1,000 more a month? I mean,
right. Tack that on to everything else that they're paying for. And, I'm sure
and this is why we know repairs haven't been done, which means everybody thinks that that Zestimate is like, no, you didn't make those repairs. Just wait until you get to that closing table. Yep.
That's a good point too. So you mentioned mortgage delinquencies. They're on the rise. Unemployment is the stated reason for delinquency. It's approaching double pre-pandemic norms, but we have low unemployment. What's going on here?
What's going on, Gary? I mean, I think, Mike Green does a really good job of talking about the birth death model and sort of what's happening to our official figures. But even looking at the way we look at the unemployment rate, we know since the GFC, so many people have left the labor force. And so, in my opinion, we've really been struggling since 2007, and we've never really recovered. So, there's so much nuance in those numbers, and we double count people that have 2 jobs. So a model that doesn't work, double count it. There's so many reasons why that unemployment number is not a good way to look at what's happening.
If they left the workforce, can they use unemployment as a reason for delinquency?
No, I mean, well, okay, if they left the workforce, they're not getting called. I mean, they've just disappeared, a lot of them. Now, in the household survey, maybe they would be able to talk to them, but, they're not the ones, like, it's been years now. They're completely out of the workforce.
Yeah. So, okay, so you mentioned how frozen the real estate market has been. It's been this way for several years now. it seems like the eyes are on the sellers. Are they going to, feel the squeeze in 2025? Are they going to come to the table and say, okay, it's time to put the home on the market here, expanding inventory and pushing prices downward? Is that what you're expecting in 2025, that the sellers start to be the ones to move?
Absolutely. And I think, I think you're always going to have demand by, because of life events like death, divorce, losing your job, things like that. So there is going to be demand. People need to move. They're going to have to buy. And these return back to office will be very interesting. A lot of them have already had a big impact of people leaving these COVID hotspots. But yeah, absolutely. And so we're definitely, in my opinion, I think that 2025, we will see the biggest price pressures. We won't bottom for several years, but in reality, there's just so much happening this year in terms of these forces, these headwinds just meeting all at once.
So, okay, I'm going to reserve this question to the end, but you mentioned earlier about motivated selling switching over to distressed selling. So, Melody, what indicators are you seeing that's kind of alerting you that this shift has taken place?
So what I'm looking at is a lot of some complicated mortgage constructs, really. I'm looking at I am, of course, looking at delinquency and default and things like that. I'm looking at credit metrics, but I'm also looking at servicer advances and what those are. That's how much you have to advance because your borrower does not have enough money in their escrow account for their taxes and insurance. And so that will start to increase and that's exactly what happened last year and the year before. Actually, this has just all been building. And so those advances are they're getting higher and higher. That's going to create a burden on the non-banks as well. But that also tells you that the borrowers did not have the cushion in those accounts to pay those taxes and insurance, which means that's higher payments for them in the future.
So what can we expect to see in a distressed selling environment? Like, what are going to be some of the signs?
The slash and burn, just slashing prices. And so let's take San Antonio. You've already had distressed selling there by institutional investors. They got their, because in Texas, they don't get, there's, if you are a homeowner, there's certain, you get less, what is it, a homeowner exemption? Sorry. So your taxes are lower, but those institutional investors don't get that. So what happened? They got a $30,000 assessment. They weren't renting their property out at what they thought they could get. They started slashing the rent. They still couldn't do it. They couldn't do it with incentives. And so what do? They start trying to sell and they aggressively do price reductions. And you're seeing that in markets in Florida, and markets in Texas. And I think that distress with all these tech layoffs, right now what's happening in California and why I call that more motivated is because these tech, they still can sell their house even if they've been laid off. And there's these NVIDIA millionaires on the other side of it who want to buy it. But that's a very limited number of people. And I've seen luxury in particular sit in all the 15 markets that I track in California.
So with price increases that we've seen over the last couple of years, if they start to go into a slash and burn situation, they've got some margin in there before they have to pay to the bank when they turn the keys in, right?
Hello, 2005 and 2006. Yeah, they do, but they better act fast because every one of those corrections, all of a sudden your loan to value goes down and then your options are you run out of options. You can't refinance.
Right. So how long do they have here? Is it of a window in your estimation? Are we talking, less than 12 months where that window is going to close and then they're going to be facing basically just handing the keys in like what we saw in 2008?
It could be. That all depends on the political situation and what workouts. But yeah, I mean, that's the thing is, they don't have a lot of time, Gary. What's important is the New York Fed just released a paper that they had the highest rejection for refinances than they've ever had since they started tracking it. What does that mean? People went and they're like, I can refi. I got plenty of equity in my home. I'll be able to save myself that way. It was a 26% rejection rate. Those people are going to start moving from motivated to distressed.
I
And
would
so, yeah,
I would think many of those folks are going to be upset with their realtors who told them to basically date the
date the
rate,
rate.
marry the house. You could always refinance later on.
Yeah, I feel sorry for some of these realtors. They might want to think about moving. I mean, I think that you're already seeing it all over social media. I mean, people are angry and they're about to get angrier and angrier. And
Well,
if they can't, yeah. And the banks, just like the banks couldn't handle it last time, Gary, the only reason we got out of the GFC is that the government turned to Wall Street and BlackRock and some of those and said, we need your help with these distressed assets. And then you had hedge funds moving in to purchase all that property. The problem this time is it doesn't make any sense for the hedge funds, and they're so over leveraged. So even if rates come down, they're already in so much trouble. There's no cash on the sidelines. I mean, that's, for them to come in and get those properties. So the banks, I think, will likely have to turn to the government, and the government might get into acquiring these even homes that maybe weren't backed by them initially.
there was a report that I thought I read recently within the last couple of days that BlackRock was trying to offload a significant amount of their properties anyway in their portfolio.
Yeah, people always so we have to be careful. Blackstone is the one who has most of that real estate of
Oh,
the single family. But I did see something recently as well on BlackRock and some portfolio of theirs. So I'm not exactly sure, but they're all trying to they're hiding it. They're hiding it in onesie twosie sales, or they're selling it. What 2024 was just a total game. They sold them to each other so they wouldn't have to take these huge, because they all know they have to it was, extend and pretend, stay alive till 25, but everybody believed those rate cuts were coming. They still believe it, Gary. They really do. And so until they don't, that hope is up and they realize it's up, then we're going to start seeing them not just sell to each other. They're going to be in trouble enough that they'll have to offload them in the market.
Well, that ought to be interesting. So, Melody, some have done calculations on trying to restore housing affordability to the 2016 to 29 levels. Number one, there was three different scenarios they came up with. One, if the U.S. income spiked 60%, we'd return to pre-pandemic housing affordability levels. So basically, in that case, we need a wage price spiral that brings massive inflation with it.
Right.
Number two was if U.S. homes fell 38%, we'd return to pre-pandemic affordability. So basically, we need a 2008 style real estate crash that brings a lot of ramifications with it, including bankruptcies, higher unemployment, people turning their keys into the banks, and
municipalities who don't get that tax money anymore, muni bonds. I mean, it's a disaster.
It's a lot of carnage that comes with number two. And number three was if mortgage rates fell about 5 points from over 7% to about 2.23% was the calculation. That would get us to pre-pandemic affordability levels. So in that case, mortgage rates would have to drop to basically historic lows that we saw right at the onset of the pandemic. In fact, I don't even think at the pandemic they got that low, but maybe they did for like a day. But I remember seeing around 2.5, 2.75, but I don't remember seeing 2.2. Anyway,
and the Fed was buying the MBS, which was inflationary.
That's what I was going to say. It's also highly inflationary because of the incentive to buy, et cetera. So basically, we have a 1970s wage price spiral, a 2008 real estate crash, or a post-pandemic historically low interest rate environment to get us back to housing affordability.
Which created inflation. Yeah.
Yeah. So is any of these likely to occur? None of them? Like, what are you expecting here?
Well, the most natural thing would to let the market decide and to let these prices correct. We know, though, it's very difficult to say exactly because we're out of options, Gary, but they're going to try. That doesn't mean they're not going to try more things. What they'll probably try more of are more loan modifications, workouts. The AGs will get involved. Once we get to a level of distress, They'll blame the servicers. They already did that. They're already starting that. And that's how they got the VA moratorium, which just got lifted. They blame the servicers. And so they'll foam the runway. This is what they did last time. Geithner said this in testimony. They will just make it last long enough that the banks can theoretically recover. And so I think what will ultimately happen is, the Fed, all the regulators are going to step back from these capital requirements, and the banks will bring all this stuff back in house. The non-banks will go away. Maybe they let one survive. But essentially that's going to be your solution, and the capital requirements get released. The banks start lending back into the mortgage market because they really haven't been. And then but that they're just going to kind of make those losses drag out over time, which is what they've done before. But things could get really crazy. I mean, that's like the optimistic view, but there is so much vacancy out there, Gary, in the multifamily and these single family homes and these new builds. I have a feeling the counties are going to be turning to the federal government and saying, we are in severe distress and we need help. And so in that case, they would turn to someone like BlackRock, and they might again fund them. But these things are, they're just extending it. It's not going to change the scenario overall. So.
All right. So, Melody, with everything that we've discussed and covered from all your research, which is extremely vast, are you expecting 2025 to be the year that the increase in the cost of home ownership via interest rates, insurance, maintenance, property taxes, et cetera, translates into a broadly lower home price, or does the current regime keep continuing?
Yeah, so it's a little scary to say because, if we don't have transactions like we didn't last year, that median price looks higher. However, with what realtors doing, what the builders are doing, I think there's no escaping it. The builders, they have to move those houses. They simply have to. So I think 2025 will be when we have real price discovery, when it will begin. It will not be the end, but I do believe we will likely see double-digit year-over-year in aggregate, looking at both new and existing home prices, corrections in 2025.
Will this slide at some point, whether it be this year, next year, the year after, since it's going to be a multi-year slide, are you expecting this to tip the country into recession?
Well, Gary, I think we're already there. I think that we've done a lot to try to hide it. I think, Danielle DiMartino Booth does a great job of looking at all these metrics. But every time you read a new news story, we haven't seen this since 2008. We haven't seen this since 2000. And when they say 2009, it's bad. Because everybody was still, I remember myself sitting with my leadership and they're like, when do you think the housing market would correct? And the options were 9 and 10. It's like, no, dudes, like that. But that's how the rest of the economy thought too. But by the time you got to 2009, everybody knew what was happening. Yeah. And the stock market, knew what was happening. So when you see things that are as bad as 2009, we're already in a recession. Whether they're going to call it,
so you think there's like a scales falling off the eyes situation that's going to happen at some point.
Right. The GDP, when they adjust for all these jobs that we didn't gain, when you get that QCEW, those quarterly estimates where they're going out to millions, not just, surveying 600,000 firms that, by the way, the response to that survey is way lower than it was prior to the pandemic. But when they go directly to these 9 million firms, you see that we've shed, a lot of those job gains were not real. And the private market, government has been doing okay, healthcare, but otherwise not good. And that will change the GDP calculations once people accept that we didn't create all those jobs. Then that changes the GDP calculations. So. Yeah.
This has been a fantastic conversation. I can keep on going here. But before we wrap up here and I ask Melody our final question, I want to point everyone to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Melody. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. For our premium subscribers, we just launched the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analysis and insight reports into either the broader metals and miners markets or a deep dive into the specific metal or specific miner. And these are written by the same experts that you see interviewed on this YouTube channel. The first report is on an extremely undervalued silver miner that you must read. And the second expert report, researched by Vince Lancy, is due out next Wednesday, January 22nd. So head over to metalsandminers.substack.com, put in your email address to subscribe for free and receive the free gift on us. And while you're there, check out the premium subscription that includes the Inner Circle. Also, I'm positive that you've enjoyed the conversation with Melody as much as I have. Please let her know. Hit the like and subscribe button and leave a comment below the video. Melody, I'm going to do a lightning round with you. I'm going to ask you a few assets as a buy or a sell by giving a score of 1 to 100, with 100 being an extreme buy and 1 being an extreme sell, and then giving just one sentence as to why you take that position. And if you don't follow the asset, it's completely okay. All right. So on a scale of 1 to 100, is gold a buy or a sell, and why?
I think it's a buy. And I think so with gold, I would give it 100 as long as everybody doesn't go like crazy. I think that's something you should have in your portfolio. Absolutely should. Now, don't put all your eggs in one basket would be my, advice about anything. And just be smart about it. In terms of the allocation to your portfolio. But I would say that's a buy. It's 100, not 100%. Of your portfolio, but definitely 100% you should be buying gold.
Okay.
And this is not investment advice, though.
Correct.
Sorry.
Correct.
Okay.
No, just your perspective.
Yeah, this is my perspective. Personally, what I would do personally. Yeah.
And on a scale of 1 to 100, is silver a buy or a sell, and why? I mean, silver is used in a lot of industrial applications, the electrification of everything. It's also a monetary metal, and we're seeing a lot of challenges that are putting pressure on the monetary metals.
Yeah. So that I would also say, from my personal perspective of what I have done, it is a buy. I give it maybe a 90. Just, you have to be careful because of the speculative nature of silver. That's the only thing I would caution, but I think you should have it personally.
Okay. Now, copper's used in a lot of real estate. And I'm curious your perspective here with what's coming. Is copper a buy or a sell, and why?
Well, so because of, the China, there's so much in the copper market that I don't know, Gary, but I do know that I know more buildings where all their copper was stole, especially these new builds. So obviously there's a scarcity element there. So I would not just, I want to be neutral on this one, but I will tell you that we need the copper. So that's all I can say, but I don't follow that market.
Would you rank it like a 50?
Yeah. And I'd make somebody who knows more about it go talk to them, because I think so, but I just don't have time or know enough.
I'm asking this of everybody. So I'm just curious. And, I don't know if you follow the energy space, but if you do, what's your take on uranium?
Well, so stepping back from the markets and what happens there, because there's a lot of speculation there has been historically with uranium. Like, to me, this is our hope. This is our great hope. I mean, we need, for quantum computing, for AI to work. And right now what's going on is an absolute mess and disaster, and they're nowhere near where they need to be, in my opinion. I come from the tech space. But we need nuclear, and it is, to me, it is one of the more exciting things upcoming. But so I would kind of say, I don't know what's happening to the price right now. I have none of that information. But in terms of long-term needs, I am fully behind nuclear. So
if you had to put a number on it, 1 to 100, what would you put it?
I'm too cautious, Gary. People don't want to listen to me because I'm just, I think, an 80 of, but that just be smart about what you're buying. Yeah.
Well, that was fun. I appreciate you. I appreciate you answering those questions.
Thank you.
Melody, thank you for coming on to Metals and Miners and for being so generous with your time and your analysis and ideas. It's been fun as always having the conversations and spending time with you. Would you care to just quickly summarize your views for the audience and also let those know tuning in where they can learn more about your work and how they can connect with you?
Yeah. So just really quickly, guys, what I just want everyone to understand is your Zestimate is not what you're going to get for your home if you need to sell it or refinance it. And so it's very important for you to revise your expectations on that. And I understand at this point, Gary, someone's always going to say, well, in my market, people are still bidding over asking. There are certain tiny little neighborhoods where that's happening. But I think they're all going to be surprised. The loudest people at the country club are always the ones most levered. And those people are going to start to disappear. And suddenly you're going to start to see for sale signs in these neighborhoods where no one thought there would be for sale signs. That happened in Dallas last year. I heard the same thing. Fort Myers, great example. Sales are down significantly. Inventory way up. Prices down. So you have to be careful and you have to unpack these narratives you're reading in mainstream media. And you also have to accept that maybe we all need to accept this. We're not as smart as we think we are. And so we need to be cautious. And so for anybody that's thinking they want to sell a home in the next year or so, my advice would be to go ahead and list it and see what kind of interest you are. And by the way, the spring is not bringing a miracle. It's not bringing 60% pay raises, right, Gary? That you will know of? Right. So everybody who's saying I'll wait till spring, the miracle won't be in spring. Even if rates are lower, guys, we had a little bit of pickup in the housing market, but not a ton. Those rates would have to get down to that 4.5% or lower for this housing market to really turn around to levels that would make it an okay for you to sell your home and get that kind of price. So my 2025 is going to be a tumultuous year. So pay attention to what's happening. Try to, debunk those narratives. And the way you can do that is honestly, that's what I do in my Substack. You can on M3_Melody Substack. That's where I write in detail about all these different levers that could be pulled because the path is clear, but there could be, exit signs, mile markers where things speed up and slow down. And that's what you really want to have your eye on. And then on Twitter, you can find me at M3_Melody. My YouTube, I will probably restart doing market updates there in February.
Everybody, if you're not following Melody, you really need to be. If you are either buying, selling, or have somebody in your family buying, selling, if you're invested in this space, she's got her finger on the pulse. I've been following Melody for several years. You guys really need to be paying attention to what she's putting out there. She's really on the forefront and she's got a heart to help people. So really get behind her, follow her, listen to her. It's important. Melody, I look forward to having you back on again sometime soon. Thank you for being here with us. And everybody else, thanks for watching.
Thank you so much.
Everyone to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one with Melody. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. For our premium subscribers, we just launched the Inner Circle. It's a rotation of 2 to 3 monthly in-depth expert written analysis and insight reports into either the broader metals and miners markets or a deep dive into the specific metal or specific miner. And these are written by the same experts that you see interviewed on this YouTube channel. The first report is on an extremely undervalued silver miner that you must read. And the second expert report researched by Vince Lancy is due out next Wednesday, January 22nd. So head over to metalsandminers.substack.com, put in your email address to subscribe for free and receive the free gift on us. And while you're there, check out the premium subscription that includes the Inner Circle.